All right, I think we are live now. Hey y'all, how you doing? This is Dr. Kelly again. Welcome to week 2 of our Hillmantok University Stock Market slash Stock Options 101 course. So I'm excited to be coming with to you through YouTube. This is new for me, so I figured it out last week. So hopefully this week it goes well. Somebody type something in the chat. Let me know you hear me, see me. Okay, I see stories. We Berry, it says good morning. Good morning to you too. How are you? How are you? Hey, Mr. Anthony, how you doing? Excited to have you in class starting on Thursday. Got our Wolf of Wall Street class coming on up. Excited to have you there. All right, all right. So we are going to go ahead and get us started. So let me, because we're going to have a nice little quick session today. It's Lashandra. Oh, okay, good. Okay, cool, 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 cool. It's funny. We always got to figure out our names on different platforms. And like, well, who is that? Who is that? Who is that? So, all right, all right. So let me do this, and I think it will let me share my screen. Let's see if it will let me pull up my screen. And yes. All right. Let me know in the chat if you guys can see my screen. Let me see if I can pull it up on my phone to get us all situated. Let me see. Go here, Chrome. So we are here. Let me pull up this. Let's see, YouTube. Give me 1 second. I'm just going to go ahead and check over here because I want to make sure everything looks good. All right, all right. I'm gonna come back over here just make sure you guys. Can you guys see that screen? Can you see the screen? Can you guys see my screen up where it says investing instruments? Let me know if you guys can see my screen. Okay, good, 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 good. Okay, good. Okay, all right. All right, well, let me get on over here and start to teaching. All right. So I am going to be talking about our investing. Let me see if I can do slideshow. Hopefully it'll work. Okay, that looks good. That looks good. Oh, let me do one more thing. Let me send. Yep, send. Okay, cool. All right, get back where we were. All right, so I hope that comes up. Let me look at this. All right, cancel live. Okay, cool. So, all right, thank y'all. Appreciate it. Finally got it. Finally got it. All right, so today, thank you again for your patience. I appreciate that. I got to figure out how to edit all this stuff out where I'm trying to figure stuff out, make sure it works. Today, we're going to be talking about investing instruments. Now, in last week, we talked about, I'm going to do a quick review. We talked about global markets. We talked about how possibly the market might crash because of this, but that's an example of a macroeconomic factor that might affect the market. We talked about what the financial markets are. We talked about the new face of the market. We talked about the different players in the markets. And then we started understanding different investment vehicles and their risk to reward ratios. And then we talked about how stocks are bought and sold and how I have my trading retreats in Puerto Rico where clients come down, we have fun, we make money during the day, and then we go play at night. Okay. And then putting it all together, I talked about I am a retail investor, just as you would be, who uses high risk investment vehicles, including stocks and options, using a middleman, another player called Robinhood, that gives me access to the stock exchanges. So that was putting it all together. So now we're going to talk more specifically about investment instruments. So we know top of mind is stocks. Okay. We also have bonds, we have mutual funds, and we have exchange traded funds, which are called ETFs. Now, inside the stocks is options. That's where I live. All right. But we also know about real estate, commodities, crypto, retirement accounts, PPFs, and debentures. We're going to stay up here. That's what we're going to talk about today in today's session. Now, one thing I do want to say is I encourage everyone to follow in my lead. Whenever you make substantial money over here in the stock market world, and of course, that's where stock options are, and stock options allow you to really multiply your money, multiply your investments faster. It is probably the only place I found where someone can consistently take small amounts and multiply them and do it on a consistent basis without having to wait for something major to happen. There's always a stock that's out there that's going to move. And when we are living in the stock world, one of the things that always makes stocks move consistently is when they have their earnings. Earnings happen 4 times a year. So once you find stocks that move very, very, very volatilely, that's when you can make a lot of money in the stock market. Okay. Other than those times, we know stocks are going to move periodically all throughout. Pick different ones. You know, they're going to move for different reasons. We are able to take advantage of those. So let's move on. So, what are stocks? A stock is a type of investment that gives you part ownership of a listed company. Okay. So we become what's called shareholders when we buy a small piece of a major corporation. Okay. So we know about McDonald's. If you want to buy a small stock, a piece of McDonald's, a small piece of McDonald's, we will call it a stock. Okay. And so we become shareholders. So here's an idea of how stocks work. Okay. Companies will issue stocks to raise capital in an initial public offering. Okay. So you got companies that are starting up. And then after the company has been in business for a while, it can decide to go to the next level. In the beginning, the company is a private company. So, like my company, the Stock Options Trading Academy, that is a private company. Okay. But there is a time in the future where I will be doing an IPO, an initial public offering, where I'm going to be taking some of the shares that I have in my company that I own, and I'm going to be selling them to people on the open market. Okay. So it's going to be a for sale sign on my shares of my company. Okay. So then members of the public and investors are going to buy my shares, and they can take advantage of the price movement, the volatility in my company, and say, you know what, I want to invest in some shares, and I want to be able to buy and hold, or I want to buy and when the price goes up, sell them. Okay. And it says stocks are bought and sold based on expectations of corporate earnings, which I was just mentioning a few minutes ago. It says shareholders can make a return on their investment by selling shares at a higher price than what they purchased at, or they can receive dividends, and or they can be paid through derivatives. Now, derivatives is one of our new vocabulary words for today. Derivatives, a type of derivative, is a stock option. Okay, so options are derivatives of the main stock. Okay, so we know the main stock as, for example, Microsoft, but the derivative might be something like, for those of you who already know a little bit about options, you might hear me saying, go buy the hint, April 410 call coupon or call option on Microsoft. That is a derivative, an example of a derivative. All right. All right. Now let's get into mutual funds. So, what are mutual funds? Mutual funds are professionally managed investments that pool money together from various investors to create a diversified portfolio of assets. So they might get money from the fireman's pension fund, or they might get some from the nurse's pension fund, or the teacher's pension fund, or me or you. So all that money comes together in a pool. All right. So that's the diversified portfolio of assets, money from different places, allowing individuals to access a broad array of securities without owning each one directly. So then all of our money comes together and is allowed to be invested in different types of um, collateral, for example, stocks or bonds or whatever that particular thing is invested in. So let's look at some examples of how it works. Okay, so investors pool their money. The money goes to fund managers. Okay, they invest in portfolio securities, and again, inside the portfolio could be stocks, bonds, anything that's hopefully going to generate a return. So once the fund managers generate a return, then they're able to pay the investors a little kickback for having their money sitting inside this particular fund. All right. So that's an idea of how mutual funds work. Okay. Now we're going to get into bonds. What are bonds? A bond is a fixed they say aka fixed income. It's an instrument used by governments and companies to raise money by borrowing from investors. So basically a bond is like a loan. Okay, so we've all heard of junk bonds, we all heard of municipal bonds, and then there's treasury bonds and corporate bonds. So basically a city or a government says, we want to build a new school, we want to build or improve a highway, we want to create a park for the city. So they will create a bond. It's basically a piece of paper. And so us regular people who live in the city are like, yes, we need a park for the kids. Or yes, we definitely need a new highway, or we need a new whatever. So investors will be like, I'll go buy this bond. Okay. So the investor puts up their money, and they are now holding basically an IOU, a piece of paper that says, okay, you've exchanged your money for this piece of paper, and this piece of paper, the bond, entitles you to receive payments over a period of time. It might be a 10-year bond or a 20-year bond or whatever. And basically, before you get it, you would know what type of interest or ROI you're going to receive from the bond. So you're going to be receiving that income, that ROI, that interest. You're going to be receiving that over time, little bit of pieces of money. And again, it's depending upon what the ROI is or the interest rate that the bond pays. You're going to be receiving that every single month for a period of whatever, 5 years, 10 years, 20 years. And then at the end, you're going to get your initial money back plus all the money you've been getting over the course of that time period. So that's what a bond is. And again, we're just talking about the different types of investing instruments. Okay, so now here's a perfect example of how it does work. So a lender, okay, like an individual or a firm or a government creates the bond, okay, and a lender purchases a bond from the lendee, and the lendee is the firm or the government. Okay, they receive the interest payments from the lendee. All right, and then at the end of the term, the lendee, this company or government or whatever, is going to give back to the lender, you or me or whoever, the amount they paid for in the beginning. Okay, so you're always getting your initial amount back for your loan. All right, and then of course the interest payments you get in between. Okay. So now we're going to talk about the ETF, which is the other type of investing instrument. An ETF stands for Exchange Traded Fund. An ETF is a specialized investment company that manages a single portfolio of investments, including stocks, bonds, real estate, and other assets. Okay. So it allows investors to buy many stocks or bonds in a certain market segment all at once. And I'm going to be sharing a couple of those with you a little bit later. Okay. ETFs are traded just like stocks, and they're traded whenever the stock market is open. We all know the stock market opens at 9:30 a.m. Eastern time, 6:30 a.m. California time, Pacific time, and closes at 4 p.m. or 1 p.m. So we know that just like a stock, an ETF, which holds stocks inside of it, an ETF is going to move up and down during the course of the stock market trading day. So you might have an ETF that's costing you $400, right? And it's going to go up to 410 and come back down to 408. It's going to go up to 415, then it might fall down to 392. So it behaves just like a stock. Okay. All right, so now how do they work? So ETFs or exchange traded funds are funds that trade on the stock market, like I was just sharing with you. Okay, so over here we have stocks. Over here we have mutual funds. Stocks, you can buy and sell ETFs just like stocks whenever the market is open. And over here, like mutual funds, ETFs can help you diversify your portfolio. Okay, so and you can invest in a ready-made basket of stocks or other assets in one go. So basically, what this is showing you, this Venn diagram is showing you that it acts like a stock, it acts like a mutual fund, but it's something different. It's called an ETF. Okay, so here might want to take a screenshot of this last slide. These are examples of the top 10 ETFs and a look at some of the top stocks as we go into 2025. Okay, so you'll always hear me talk about SPY over here because it is the top ETF, right? SPY includes many, if not all of these stocks here. Many, if not all of them, are included inside the SPY ETF. It is the basket that holds a lot of these stocks here. All right. And let me see if I can show you one additional thing over here. If we go over here to Yahoo Finance, let me know if you guys can see this part of my screen. Let me know if it's sharing. It doesn't look like it's sharing. All right. I'm going to pull this up real quick and then show it to you. Hopefully, be able to show it to you. All right. What I'm pulling up are the holdings for SPY. So I'm just going to talk it out to you because it's not coming up on the screen. So now, the top holding for SPY, the ETF, is Apple. The next one is Microsoft, then NVIDIA, then Amazon, then Meta or Facebook, then Google, then Tesla, and then we get into Avgo, Google, and Berkshire Hathaway. All right. So those that I just mentioned, coming back over here, those that I just mentioned, all of those are here in what they call the Batman stocks. Okay. Batman stands for Broadcom, Amazon, Tesla, Microsoft, Meta, Alphabet, Apple, and NVIDIA. All right. So they put that together. So now they have a new, I'm pretty sure they're running this as a very new ETF. So once they get this thing up and running, you can just invest in this, and then you're going to be benefiting from all of these as they run. Okay. And as you can see, they got different percentages of those companies. Okay. All right, so we got over here the top ETFs. We got SPY, we got IVV, we got VOO, we got VTI, QQQ, VEA, VUG, BND, VTV, and IEFA. Okay, some of these I know of, and some of them I don't know because I like to focus on stocks that I know and I'm comfortable with, or ticker symbols. Of course, these are all the ticker symbols, right? I like to focus on ones that I know that I'm familiar with. All right. I'm not trying to spread myself too thin by trying to trade all of these. No, I'm not. Okay. I want to do one or two or three. All right. And then when I come over here and I'm looking at specific stocks, I'm going to be doing the same thing. I'm looking for specific stocks that I know how they perform. And that way I can take advantage of them as they are doing their thing and hopefully making money off of them for myself. And that's what I teach my clients how to do. All right. So that is our, oh, no, it's not. It's not the last one for today. The last one for today. Last week, I gave you, I'm trying to share some free money with you. So I shared with you the Robinhood link. This allows you to get free shares, fractional shares. A fractional share is when you get a piece of a share, as opposed to you might not have $420 to buy the whole thing, but you might have $8 or $10 or $5 or $50, and you can buy $50 worth of that particular stock. Okay, so that's what that you get with Robinhood. And here's our new gift for today, which is you get up to 20 free fractional shares on Webull. So this link here will get you that type of investment. You're just going to open up an account at Webull, deposit. I don't know if they want you to deposit $50 or $100 or whatever it is, but all you got to do is transfer money from here to here and they give you free money, I always go for it. Okay, especially when I know it's a good company. All right. So that is our quick lesson today, understanding different investment vehicles. These are two of the platforms that allow you to actually do your investing so that you can make your money by buying, whether it's fractional shares or full shares, or you're doing dividend investments, or whether you're doing options and you're doing derivatives. So I look forward to seeing you next week. Hopefully, I'll get this thing down to a science and we'll be ready to go and stream through multiple platforms. But thank you so much for coming. I hope you got some good value out of this. All right. Alulam, thank you for the comment. I see the graphic is being blocked by your image in the bottom right. Thank you for giving me that information so that I can figure out how to do that and change that. So I will be working on that. Thank you so much. All right. Thank you, Mr. Anthony. I appreciate the support. And you guys are so welcome. Elite Society, Elite South Society, you are so welcome. That's right, Chandra. I appreciate you as well. You're welcome. So again, I look forward to seeing you next week. Hopefully, I'll have some of these extra things put out. And let me see if I can drop this. Let me see if I can drop this link in the chat for you guys. Let me see if I can do that. That way you guys can go ahead and let's see if I can drop it in the chat. Oh, yes, I can. Perfect. All right. I just dropped it in the chat, so you can get the actual new app that's going to give you some free fractional shares. So I just dropped it in the chat for you. So go ahead and click on that, save it, do what you got to do so we can go ahead and start getting all this money in all the different places we can get it in. All right. Well, all right, y'all. Take care and have an amazing rest of your day. I look forward to seeing you next week when we get into week 3 of 8 in our Hillmantok University stock options 101 course. All right. Thank y'all so much. God bless. And I'll see you next time.